30th report release of the city's fiscal conditions. We're very excited to have you, and thank you all for just joining us. This is one of our larger forays into New York, and we're very happy to have you here, and we certainly look forward to this being the first event to start a conversation of a lot of our reports and analysis in the future. So with that, Clarence Anthony, CEO and Executive Director of National League of Cities.
Good afternoon. My name is Clarence Anthony. I am the CEO and Executive Director of the National League of Cities. We consider the National League of Cities the organization that is the voice of cities for America. The National League of Cities is 90 years old, and as many of you in this room know, there's 19,000 cities, towns, and villages in America. And I say that because as the CEO, I often get in trouble with the town and villages of America, because I usually say 19,000 cities. So whatever you write here today, if you're a reporter, please include the towns and villages in any reports. But you know, we are pleased today to be in New York City, outside of Washington, to talk about and present the fiscal conditions of American cities, towns, and villages. It's important to note that this is our 30th edition of the annual City Fiscal Conditions Survey. Since 1986, this annual report has provided elected officials, policy officials, financial analysts, and of course the general public, basically a window into the health of cities, towns, and villages throughout America. This report helps city officials to plan, to dream, but also be realistic about what tools are available to them, what has worked throughout America, and what, in fact, they need to look forward to in the future. Why does this matter? A lot has been written over the past few years about the importance of cities in the 21st century. And you can read almost any report in papers or in think tanks, and it's right now all about cities. In fact, years ago, when many of us were growing up, the question would be asked of us, what did we want to be when we grew up? And we were sort of taught to say, we want to be president of the United States of America. Well, now when you ask a child, what do they want to be when they grow up? The answer is most often, in my household, I want to be mayor. And so it's so important that we recognize the fiscal conditions of American cities. But this calls us to act. Finding out what is important and what is happening causes us to act and be able to address the many challenges and demands in cities, and try to figure out how do we engage community partners to tackle the many tough issues that cities are facing, such as housing, unemployment, aging infrastructure, and many other issues that city leaders are facing. The ability of our cities to bring their leadership to many of these challenges, especially the fiscal health of communities, is an important element that most cities try to think about every day. So today's research and today's report really will give you a true peek into what city officials are dealing with, what are those tools, and how, again, they anticipate moving forward in the future. We're honored to have a great panel, and I think you're going to enjoy the conversation, and we hope that you'll be part of that conversation. We'll have the researchers, who's been leading and partnering for years, putting out this report. We'll have financial analysts, because oftentimes, especially in the muni bonds business, they're very concerned about what truly is happening in cities and the health of those cities. And we'll have a local leader. We have Mayor Chris Coleman, the mayor of St. Paul, Minnesota, here, a past president of the National League of Cities, sharing his real-time perspective as a local leader. They'll really dig into key indicators of city fiscal health, providing us with nuanced look at current conditions. And again, the most important thing I want to leave with you is not about what happened last year, but what should we expect in the years to come. Let me start by bringing up Mike Pagano to get this discussion started. I'm pleased to introduce Mike, and he's been a part of this report for years and one of the major authors. He is Dean of the College of Urban Planning and Public Affairs at the University of Illinois at Chicago, a professor of public administration, elected fellow of the National Academy of Public Administration, and for 25 years has been a co-author for the City Fiscal Conditions Report. I ask that you welcome Mike up today, and he'll get our discussion started. Welcome, Mike. Thank you again for coming.
It's a narrow stage.
Yeah, thank you so much.
Well, good afternoon. It has been a long 30 years. I actually was involved in the very first report of the National League of Cities, City Fiscal Conditions Report, when I had a lot more hair. This, just by way of background, I'm going to introduce my co-author who will go through the findings of the report, but just to set the stage for why I think this is an important undertaking on the part of the National League of Cities, is that many of you may remember, many of you may not remember, but in the 1970s and the early 1980s, we used to have a congressionally authorized report on city fiscal conditions that the Joint Economic Committee produced. The Joint Economic Committee worked with the Government Finance Research Center under the auspices of the late John Peterson, and with the staff of the Joint Economic Committee in producing a report on the fiscal conditions of the largest 75 cities. It was a biennial report. It was well received. It provided a lot of insight into the largest 75 cities. Didn't say much about those that were not part of that report, but it at least gave us a sense of what was happening in urban America, at least to the finances of cities in urban America. In 1984, the Joint Economic Committee decided that it had done enough, and it stopped producing the reports. And it was at that time when the National League of Cities found this to be a very useful document for them. I found it as a researcher to be a very useful document to do work with and understand how cities were performing. And at the time, I happened to have a fellowship at the National League of Cities for a year, and the conversation was, who can do an annual or a biennial report on the state of America's cities, the finances of America's cities, if we don't do it? Well, I thought that was a terrific idea, and since 1986, I have been involved in one way or another as an advisor for the questionnaire construction. And of course, in 1986, the first year, we used to use something called the U.S. Postal Service. I'm not sure where they are anymore, but it's now all done on the internet. The questions then were really about a little different from what the Joint Economic Committee asked. The Joint Economic Committee's report was on the full finances of municipalities, those 75, and it included their enterprise funds, their capital improvement funds, special funds, and everything else. Those were, because those are such dedicated funds for the most part, and because they are so difficult to collect comprehensive data on for a number of years, and this is a data collection effort. This is not an opinion survey. So we couldn't just ask the fiscal officers how much they thought they were spending. We needed to see the report. So it was a collection of 3 years' worth of data, the general fund, the 2 previous years and the current budget year, that we pieced together then over time to create what you have in front of you, the City Fiscal Conditions Report. In the early 1990s, I was now part of the writing team, realized that the presentation that we were making about city fiscal conditions didn't resonate with a whole lot of cities. Most cities could say, well, this doesn't fit my profile. I don't have the kind of trend that you're illustrating here. And one of the reasons was because, as we all know, that the financial underpinnings of municipalities really depend on what I refer to as their fiscal architecture. And the fiscal architecture varies by municipality. Cities, like our children, are unique, and cities, like our children, go and grow in different ways, even though we can calculate the average of all municipalities. So in the early 1990s, we began tracking the change in sales tax receipts, income tax receipts, and property tax receipts in the general fund for all of the cities that were part of the survey. All the cities in the survey amounted to any city over a population threshold of 50,000 and a sample of cities between 10 and 50,000. No, we did not. This is not the Bureau of the Census. We did not have a 100% response rate, but we had a reasonable response rate that I think resonated with the communities we were trying to reach, primarily this community, as well as the mayors, elected officials, and staff members of other municipalities around the country, whether or not they were included in the survey or whether they returned the survey. The last 4 years now, we've due to the miracle of the internet, we are now working through the CAFRs that almost all municipalities now post, at least the largest ones, as well as the online budget documents, and we're relying much less on the staffs of the CFOs of the cities to respond to the survey and the questions. What we tried to piece together, and why we think this is so important, is that you can see the trend in city fiscal conditions, or rather the trend in city revenues by major categories, sales, property, and income, as well as the reserves or the ending balances in the general fund over a long period of time. And you can track it according to any dimension you want, such as the business cycle, and as we know that the fiscal cycle does not parallel exactly the business cycle. It sort of lags it, in part because there are property taxes that take a while to work their way through the system. Sales and income tax cities, on the other hand, get hammered right away as soon as there's a downturn. So that was part of the learning process that we had, was that some cities are telling us they're suffering today, while as other cities are saying, well, it hasn't hit us yet, but we expect it'll take a couple of years to hit. So presenting the data as we do now by tracking the property sales income tax, as well as ending balances as a percentage of expenditures of the municipalities, I think provides an insight into what municipalities are facing and what sorts of things that they ought to be considering for the future. So I want to introduce Christy, but before I do so, I just want to leave one note with you that I'm sure will be covered, and that is that no matter what measure or what bench year you use to measure the beginning of the economic downturn, either the Great Recession or going back before the Great Recession, revenues in the general funds of municipalities in 2015 are not at the levels they were in 2006, 2004, or 2001. In other words, we have not rebounded in over a decade, of the effects of the Great Recession. The reason I want to underscore that is that municipalities, if you read the press, municipalities are doing better. Property taxes are increasing. Real estate industry is booming again. Retail sales are, who knows what they're going to be, but they seem to be up. And then we don't think of the challenges of municipalities. Municipals' revenues are not at the level that they were in the last decade because of the Great Recession. So keep that in mind as we think of the smiley face on City Fiscal Conditions Report, is that the numbers are looking up. That's what that graphic is indicating. But it's only up because of the relative base that we're looking at, which is the prior year. So, with that background, and welcome and thank you, I want to introduce Christiana McFarland. Christy is the Research Director at the National League of Cities, is my co-author on this report of the City Fiscal Conditions for 2015. She's been at NLC since 2001 and has launched NLC's Finance and Economic Development Program, which supports municipal leadership and city and regional level outcomes through peer exchanges, best practice curation, and technology assistance. technical assistance. Her expertise is in economic development, workforce development, global competitiveness. She has a BA and an MPP from George Washington University and is currently a PhD student at Virginia Tech, and my dear co-author, Christy.
Great, thank you, Mike, for that lovely introduction. And of course, it's truly an honor to co-author the report with you this year. Excuse me. I'm pleased to present the results of the National League of Cities' 30th Annual City Fiscal Conditions Survey. As Mike mentioned, our analysis of city budgets reveals that city fiscal conditions have stabilized in the wake of the Great Recession. Given 30 years of historical data, our perspective on current conditions can be perceived, however, in a more relative context. We're able to put current fiscal conditions in the context of the very recent recovery period, stepping back further to look at the full scope since the start of the Great Recession, and then stepping back even further compared with other recession and recovery periods. Overall, we find that fiscal conditions in the current period are showing signs of slow but consistent growth. However, city revenue bases are weaker now than before the recession. When viewed over 3 business cycles, 1990, 2001, and 2007, it is quite clear that the Great Recession has had an unprecedented impact on city budgets. Our survey also gauges fiscal policy responses and stressors on local budgets, which taken together help shape our perspective on how city finance officers and city leaders perceive their fiscal condition and prepare for future downturns. To assess fiscal conditions within the current recovery period, we examine general fund revenue and expenditure trends, as well as the performance of tax receipts over the past few years. We also assess the valued opinion of our nation's city finance officers about the general fiscal position of their cities. And that's where we'll begin. Each year, we ask city finance officers, is your city's budget better able or less able to meet the financial needs of your community this year over last? The blue bar in this chart represents better able, and the red, less able. 82% of city finance officers report that their city is better able this year than last to meet the financial needs of their community. As you'll note, more city finance officers report a positive fiscal outlook this year than in the 30-year history of the survey. But again, of course, it's all relative, right? But what really is driving this positive outlook? What are the underlying motivations for city finance officers to be so positive? And for that, we really take a closer look at the general fund, as Mike had alluded to. We focus on the general fund in our survey because the general fund provides funding for the bulk of city operations and is also reflective of local economic conditions. Based on city general fund data, we calculate the change in constant dollars from revenue and expenditures from one year to the next. The blue line represents revenues and the yellow line represents expenditures. Right now, we'll focus our attention on the last few years. Revenues and expenditures both registered their first post-recession gains in 2013, followed by slow but consistent growth in 2014 and 2015. Expenditure growth is driven largely by investments in employee wages, public safety, and infrastructure and capital projects. On the revenue side, we turn to trends in tax receipts. The blue line represents year-over-year change in property tax collections, the red line, sales taxes, and gray line, income taxes. Property tax revenues, the blue line, started growing very modestly in 2013, which was the first post-recession growth. Property tax revenues reached a post-recession high in 2014, and we anticipate continued, but again, slower growth coming into 2015. Sales tax revenues, the red line. Sales tax revenues in general respond more quickly to economic conditions than property taxes. Sales tax collections began recovering in 2011 and have grown every year since, although again, the pace of that growth has slowed. Income tax revenues, again the gray line, have been the most volatile tax source during the recovery period. Like sales taxes, income taxes are generally a more elastic source of revenue, although only about 10% of cities have access to an income tax. For cities with access to that tax, it is generally limited to wages and not capital gains, unlike our partners at the state level. Income tax revenue growth reached a post-recession high in 2012. Growth continued into 2013 with a dip in 2014, and anticipated return to growth closing out 2015. As I mentioned, sales and income taxes are more elastic sources of revenue and respond more quickly to economic conditions, whereas property tax revenues tend to lag due to the assessment and collection cycles of cities. Typically, these different types of responses create a buffer for city budgets through the highs and lows of business cycles. During the most recent recession, however, all three sources declined at the same time, and you can see that right around the 2010 mark in this chart. This is due primarily to the severity and broad impact of the housing crisis, the extent of the loss of housing wealth and subsequent effects on consumer spending, as well as slow pace of current recovery, particularly in the labor market. Stepping back, when viewed within the context of the fuller recession and recovery period that we're in currently, we can more clearly see the impacts of this triple dip in all three tax sources. This chart shows the cumulative year-over-year change in general fund revenue starting with the year prior to the recession. So in this case, year zero is 2006. You can see revenue decline with an upward trend starting at year 7 or 2013. Despite this growth over the past few years, as of 2015, city revenues are still lagging and hover around 91 to 92% of pre-recession revenue levels. Taking a step back even further, when compared to the 1990 and 2001 recessions, it becomes clear that the fiscal impacts from the Great Recession are much more substantial, both in terms of depth and duration. During the 1990 recession, indicated by the blue line, cities experienced 3 years of revenue decline, restoring to pre-recession levels in less than 2 years. During the 2001 recession, indicated by the gray line, cities experienced revenue decline and volatility for 4 years, but recovered in 2. It is clear that city budgets have reached a new normal. We're also finding that cities are adjusting to this new normal. Vast majorities of cities are balancing their budgets annually, providing critical services and employing a sizable workforce, and doing all of this with suppressed revenue base and very limited fiscal tools. As noted for many years, due to state and voter-imposed restrictions on city revenue-raising authority, the most common action taken to raise revenues is and has been to increase fees for city services. This trend will likely continue unless cities are granted additional authorities from their state governments, which I think we all know is unlikely at this point. Turning to ending balances, further evidence that city budgets are adjusting to a new normal and also preparing for future downturns is the growth in ending balances. Ending balances or reserves provide a financial cushion for cities in the event of a fiscal downturn, unforeseen expenses, or a planned project. This has become particularly crucial as federal and state aid to cities has decreased. Bond writers, many of you here today, also look to reserves as an indicator of fiscal responsibility, which can increase credit ratings and decrease costs of city debt. This chart shows ending balances as a percentage of general fund expenditures. The blue line is actual ending balances, and yellow line is budgeted ending balances. Actual ending balances are typically greater than budgeted, although this margin has decreased in recent years. Prior to the recession, ending balances hovered around 25% of expenditures. Throughout the recession, obviously, cities used their ending balances to help balance their budgets. But what we're seeing now is a return to building up their reserves. In 2015, ending balances are anticipated to be greater than 25%, which would mean that they are reaching or exceeding pre-recession levels. So city budgets have certainly been put to the test and are proving resilient even with limited fiscal tools and revenue-raising capacity. Overall, we find that fiscal conditions in the current period are showing slow signs of consistent growth. However, city revenue bases are weaker now than before the recession, and when viewed over 3 business cycles, it's quite clear that the most recent recession has had unprecedented impacts on city fiscal conditions. Looking to the future, the city becomes, what trade-offs will cities need to make to maintain that fine fiscal balance, particularly in the face of severe budget stressors, including infrastructure, pensions, healthcare, and many others? This is particularly notable given that the next recession is likely just a few years away. I'm looking forward to the panel discussion, which will explore these issues in further detail in just a few minutes. With that, I would like to once again thank you all for being here. Thank my co-author, Dr. Pagano. And before we turn to the panel, we'll take a few questions from the audience. Mike, if you'd like to come back up as well.
It's lunchtime.
Yeah, right.
Oh, are we?
Is this on? Is there any further analysis that looks at the fixed costs as a percentage of overall expenditures and then looks at structural deficits, right? Removing those fixed income expenditures in the context of the fund balances. So, you know, looking at almost like a city by city downturn risk in the event that revenues, you know, drop in the next recession and there's less things that you're able to cut.
We have not done that analysis. When you speak of fixed costs, you're speaking of personnel costs, I presume, or not fixed asset costs.
No, yeah, personnel.
Yeah. No, we don't, and we don't. We have not collected data. This survey has not collected data on the expenditure side, so we're not certain how they're dividing the resources that come into the general fund into the various lines, whether it's, you know, for public safety or economic development or whatever. So we're not certain even where the changes have been over the years. What we do know is that there were times where expenditures were clearly related to 9/11. So if you look at the 2 years after 2001, you'll see that expenditures were positive for 2 years in a row as revenues were declining. And we were fairly certain, mostly from anecdotal information, that a lot of that was going into public safety and first responders. But outside of that piece of information, we haven't done an analysis on the spending side.
I was wondering if you've done any analysis or if you thought it was appropriate to compare the revenues. When you talk about the revenues being, you know, about 10% down on a real basis from the peak of the pre-recession, that, you know, recognizing that the run-up to the recession, to the bust, was one of the most extraordinary periods ever in terms of boom and revenue generation, property taxes, et cetera, and that maybe a fair comparison would be to take a few years of that preceding period, median, whatever, and average it out, and then look at it that way. Because a lot of places didn't spend every dime they had. The more responsible places, you know, socked it away or put it into infrastructure, PAGA, that type of thing.
Yeah, I think Mike did a behind the envelope right before we got up here. So, do you want to?
Yeah. So this is anticipating Natalie Cohen's question. We did use 2001 as a base year and 2004 as a base year. 2004 for municipal revenues was the last year there was a decline. It began to increase after that fairly rapidly. 2003 and 4 were very difficult years for states, and states took it out on the cities a lot, but cities also were hurt on the sales tax side in particular. And if you use those as your benchmark years, no matter what year you use in the 2000s, we as of today are not back to that level, which only indicates the severity of the Great Recession. And that pulled it down year after year declines were more than the year-over-year increases in the build-up years. The build-up years also primarily manifested themselves in growth in property tax receipts, not so much in sales and income. Income was actually pretty flat during that time, and property is not did increase by 2008 and 9, and then that's when it began to fall by 10 and 11.
Taking the philosophy that the light at the end of the tunnel is usually an oncoming train. The oncoming trains right now would seem to be infrastructure costs and pensions. How do those look going out a couple of years or more?
Yeah, absolutely. So, I thought that was a great way to end the presentation, right? Leaving these lasting thoughts with you. But yeah, clearly infrastructure costs, pension costs, even healthcare, those are clearly the top stressors for cities. I think that'll be a focus of the panel as well in terms of getting into a little bit more detail around how those are anticipated to affect city budgets going forward.
Yeah, and if I might add, I'm in Chicago, so if you have any way out of it, please let us know. On both the infrastructure and the pension side. I think the infrastructure is going to be even as much challenging as the pension because we keep postponing that, and we can get away with it. We're now seeing there are cities that are thinking of 3- and 5-year cycles for pothole repair rather than 1 or 2 years. They just don't have the revenue.
Money financing the muni market is steady state 40% below 10-year trend
Yep.
of 2010. So scary stuff.
Yep, exactly, and that's what the next panel will be discussing.
All right, well, if there are no other questions, we'll close out this portion of the program. We'll let you enjoy lunch for a few minutes, and then we'll welcome the panel in just a few minutes. Thank you. Okay, excuse me. We're going to get started again. I am pleased to introduce Dave Litka, who will moderate our panel this afternoon. Mr. Litka is the editor responsible for municipal market coverage at Bloomberg News here in New York. Welcome, Dave, and the rest of our panel.
I think Natalie's here, and okay, I guess you're right in the middle there. So boy, girl. There you go. I think they said it interferes with the mics. So. Okay, thank you, Christy, and good afternoon, everyone. I want to introduce our panel. To my immediate left here is Natalie Cohen, head of municipal research at Wells Fargo. In the middle is Mayor Chris Coleman of the city of St. Paul, Minnesota. And to the far left is Suzanne Finnegan, Chief Credit Officer, at Build America Mutual. And again, thank you all for coming. And today I wanted to review some of the findings that we went over earlier and talk about some of the broader issues in the municipal market and how it will affect America's cities. So first, if I could direct the first question, I guess, to Natalie here, and I want to talk about the general fund revenues. In the presentation, we showed that they've increased the past 2 years, but growth has slowed, and revenue is projected to increase just 0.3% for 2005. And I want to see what this suggests to you about the health of America's cities right now.
Okay, I think, across the country, revenues are struggling in some places. We have job growth, so it's positive, but not necessarily stellar growth. There's no boom in most places. We have a demographic where we have an aging population. We have people who are retiring and not necessarily moving through those baby boomer years of heavy acquisitions of durable goods and large items for houses and so on. And a lot of caution on the part of people that are aging and moving towards retirement to save their money, given the recession and the volatility in the financial markets. People are a lot more cautious about their spending. So I would say that's part of it. But as pointed out, there's been recovery in property tax revenues and to some extent income tax revenues as well for cities that do charge income tax.
Okay. Suzanne, just the opposite end of that is the expenditures are expected to increase at a faster pace right now than general fund revenue growth on it. And is now a time when cities should be more aggressive in terms of putting controls on expenditures, given how strong the economy is, or the growth we are seeing?
Yes, I think so. I think, in a sort of ironic way, the time to really focus on your expenditures and your expenditure controls is when your revenues are increasing and when you're in better economic time. I think a lot of cities have held back on some needed expenditures, and that pent up demand for infrastructure, which we've seen in the survey, is going to result in increased expenditures. But it's a time for very conservative budgeting, I think.
Okay. And Mayor Coleman, with that being the case on it, when we are seeing this dichotomy between the two on it, what are you seeing in St. Paul and how are you dealing with it?
Well, I think in St. Paul, like a lot of cities, when the recession really hit us the hardest in 2008 and in 2007, 2008, a lot of those controls on spending were already put in place. And so I think if you look at the chart that shows the optimism that people are feeling at one of the all-time highs about their ability to meet their needs, it's largely because a lot of brake was applied in the 2007, 2008 period. And cities that have managed well have been very cautious about putting a lot more expenditures on their plate. Public safety continues to be a huge component of our expenditure. We have a general fund budget in the city of St. Paul of about $250+ million, but $110 million of property tax revenue, which is our primary general fund source. Our police department budget is $100 million. So it gives you just a little bit of a sense of what cities are dealing with, and obviously large proportions and small proportions depending upon the size of the city. But there continues to be pressure around public safety services, which fuel a lot of the expense growth, and we're not meeting some of the other basic needs that we're seeing in the city, whether it's infrastructure or libraries and parks that are providing out-of-school time services for children, et cetera. So the cities are, I think that we're somewhat stable, but we are definitely challenged, and the horizon is fast upon us.
Suzanne, just to follow up a little bit on again, on the slides, we talked about how general fund revenues have climbed about 91% or 92% of pre-recession levels on it, and aren't really projected to come back anytime soon on it. And Christy made the mention of a new normal on that, and I'm wondering if you see that if we are in a new normal when it comes to revenue growth or general fund revenue growth, and should cities be considering to do something differently right now, or what are their options?
I think one of the differences in this cycle than we've seen in some prior recessionary cycles is just the real delay in a return to the pre-recession levels of state aid. So the states cut back very, very quickly at the beginning of the recession, and sort of everything kind of flowed downhill, if you will. And the states haven't returned to those pre-recession levels, and I think that's a real constraint on the general fund budgets of a lot of municipalities. But I don't think we're going to see that turn around very quickly. The slower rate of growth in sales and income taxes is going to have an immediate impact on state budgets as well. So I think it's, cities are going to have to reflect that and have to recognize that it probably is a new reality.
Good. Well, I would, that issue of state and federal resources coming to local governments is the biggest challenge that we face. There's a reporter that covers greater Minnesota that every time I have a press conference, he says, promise me you're not going to talk about the need for more local government aid. And I said, I can't promise you that, because that is the biggest challenge that we face. Our local government aid revenues, when adjusted for inflation, are below 2003 levels, and so we have had tremendous challenges just trying to make up, given the numbers that I put out earlier in terms of what our budget looks like. If there isn't some influx of revenue from state sources or federal sources to meet some of our needs, and we do get some of that through the COPS program, providing funding for officers or for firefighters, that helps a little bit. But then those have tails for cities as well. So we take this pool of money in at the beginning, but 5 years we have an obligation to cover those costs that no longer have resources from the federal or state governments.
Right.
Natalie, did you want to?
Yeah, I would just underscore the federal side of the equation as well. The biggest cuts that the federal government has made over the last 5 to 7 years has been in the discretionary side of the budget, which is the money that has gone in the past to municipalities. So, I think that's a hole that obviously the cities have to fill and are challenged in trying to make that up.
Okay. Again, quoting from the survey, 2 in 5 financial officers said that they've raised fees, while I guess about 20% elevated property taxes in 2015. Is this going to be the trend going forward, or are we going to see more property tax increases and more dependence on fees?
Right. Fees are they're a little sneakier. They're not as visible or obvious. You pay a fee, and the theory is also it's a user charge. You consumed something, and so therefore you're paying a fee on it. They're not big winners in terms of generating a lot of revenue compared to sales or income tax or property tax, the core revenues. So they have limitations. And I think, cities are going to have to get creative about technology, about how they deliver services, how they spend, and so on to really make up for that.
I think one of the what I've seen is that often, more often than not, fees that are charged do not cover the cost of providing the service. So if you increase an inspection fee for a restaurant, that might still only cost or cover 25 to 30% of the cost of the actual inspection. So even though you're increasing the fees, there's still this kind of distance between what it actually costs and what you're receiving. And so fees are absolutely a critical piece of the puzzle for the city of St. Paul that has helped us stabilize the revenue sources. But as was mentioned, it doesn't, they are hidden, but people do eventually start to feel those things and they notice them. If you really tried to get cost recovery out of your fee system, you'd be quickly kicked out of office, I suspect.
And if I could start with you, Suzanne, another question, just in terms of property taxes. We had S&P's Case-Shiller index data yesterday showing home prices, the 20 cities they look at rose about 5% in July and are up about 4.7% over the past 12 months on it. So you're seeing some sustainability in the housing recovery right now on it. Is that giving cities enough of a base to consider more property tax increases?
I think a lot of cities, and I think some of the survey results show that cities really held back and did not increase property taxes or raise fees. Instead, they chose to use their balances that they had built up, during the good times. But now I think those balances have gotten to a level where you can't really dip down. That they need to be there for emergencies. So I do think we'll see that return. I think one thing is that the recovery, especially in real estate, has been very uneven across the country. And so some markets are growing much stronger than that, and others, the recovery really is still very weak and very slow. And so it does provide some opportunities. Obviously, it's not growing enough that people don't have to raise the actual rates. They're not getting the bump they used to get in the revenues from just the appreciation of the property values. And again, as the survey folks mentioned, the property taxes is such a lagging indicator. It takes a while for any improvement in values to really cycle through your system.
If I could just switch to Natalie here a little bit. We mentioned a few times what's going on in Illinois and Chicago. And Chicago's mayor just announced a record tax increase, and it seems like he has the support to get that passed right now on it. Is that the future for more of your distressed cities on this, or is this an exception to the norm here?
I think Chicago's an outlier, and Illinois and Cook County and so on to some extent. And because of the underfunding of their pension for so many years at the city and the school and the state level, I think that's not across the board. The numbers show that. It's also the case recently, I looked at some of the cities and the states that have poorly funded pensions. There are plans within those states that support the municipalities that are doing fine. And that's not a story that's really getting out there. That in Illinois, there's the Illinois Municipal Retirement Fund. That's over 90% funded. And many of the municipalities in the state have been paying in, which is what they were supposed to do. Connecticut, Pennsylvania, New Jersey, they each have municipal plans that are doing better than 90%. So I wouldn't say across the board you're going to see the huge tax hike for legacy costs that is being talked about in Chicago. And when you look at it, Chicago itself has not raised property taxes in a very long time. So we're in this environment now where any tax hike causes everybody's back to go up and say, this is wrong, it's bad. But it used to be a more measured, we need to fund schools, we need to fund roads, we'll raise the taxes a bit, property values are going up, and so on. So we're in this different kind of environment.
Okay, just to switch to one of the other main sources of revenues, which is sales taxes right now. And again, the survey showed that growth in sales tax revenues expect to slow for a third consecutive year on it. Is that troubling? What are you seeing in St. Paul right now?
So we are seeing, we only capture a small percentage of our sales tax revenues. Most of that is, that goes directly to the state. You actually see in the state of Minnesota a very significant, almost $1 billion surplus in the state. And of course now it's getting bogged down in the political process as to what you actually do with that surplus. We think they could give a little to the cities and we'd be happy with that. But the portion of our sales tax that we do collect has increased slightly, but that rate of growth has definitely decreased. It has not met our projections in terms of growth. And what that has challenged us to do is we had hoped to capture some more of the growth to use for general fund purposes. The piece that we get are directed towards specific projects and specific areas. And so we're seeing a slowdown on that, even as we're seeing a resiliency in the overall economy and the kind of vibrancy of the community. So we hope that it will continue to grow, but at least the current trends are slowing down.
Okay. And I would like to actually switch back to, Natalie mentioned pension funds on it. And we recently did a story at Bloomberg News where we had an analyst from Janney Montgomery Scott who called growing retirement costs the largest cloud overhanging the municipal market right now. If I could start with Suzanne on it, do you think we're in the midst of a pension funding crisis right now nationally?
For many cities, yes. I think to Natalie's point, there are a number of cities that are making their appropriate contributions to plans, but I think the double effect of a very, very prolonged period of low interest rates, and so much lower earnings in the plans than had been anticipated, combined with the fact that when faced with very difficult budgetary decisions, some cities and municipalities chose to defer that particular expense as something that was less immediate. Faced with, do I pay the cops and firemen, or do I make a deposit to their pension fund? That's a pretty easy choice, or it's actually a very difficult choice, but some cities were faced with that. So I do think that's the case. We view it as a major credit concern in our company, and in fact, we have a pension actuary on our staff who reviews every credit that we look at, and he sort of puts all of people's, all of these different municipal pension plans on a consistent basis, so we can sort of compare what the burdens are in one city to the burdens in other cities, and making sure that that's an apples-to-apples comparison.
Okay. And back to Natalie here, I want to ask on it. We cited a figure from the National Association of State Retired Administrators where they said that the median assumed rate of return by local governments is 7.5% right now. Do you see that as too high, or is that a good rate?
Well, it's high, given that the Federal Reserve refuses to raise interest rates. We could argue there's a lot of literature out there on the proper discount rate, and people could argue until they're blue in the face about what the right rate is. My view is paying in is more important, putting some money aside, and obviously managing your investments appropriately. What's happened in the last 10 years is that a lot of pension plans have gotten more aggressive to get to that 7.5%. And so there are some risky investments out there, and that's a concern. Should there be another downturn or a blow up in one part of the economy or another? And then we see plans moving down. So CalPERS, for instance, is ratcheting down their interest rate assumptions. A lot are moving down their assumptions as well.
We saw Dallas, for example, I believe they moved theirs down for their fire and police pensions, which triggered, I believe, a tripling of their estimated underfunding and credit rating downgrade on it. Do you see a reluctance among states and cities to do this, given that's the likely consequence?
That certainly pushes against wanting to do it for a city. The rating agencies have, over the last couple of years, taken a much greater weighting or put more reliance on what the funding of pensions are. I know Moody's has adjusted the pensions funding on their own. methodology, and as a result have made some downgrades. So yes, downgrades have been happening for that reason. So for sure, I mean, if you're, a mayor of a city, you're going to say, well, I don't know that I want to risk a downgrade. The accounting is also going to make a little bit more transparent some of the obligations that are outstanding. So this is not, it's not going away in terms of the discussion. I don't know that the fundamentals have changed underneath it, but it's becoming a lot more transparent.
Okay. And Mayor, as a mayor of a city with a AAA credit rating, you have obviously a different perspective from a lot of folks on it. But how do you view the pension obligations, both yourselves and nationally?
Well, I think one of the reasons we have a AAA rating is that our pension system is, first of all, it's tied into the state system, and where cities in the state of Minnesota have had challenges, the state has adjusted whatever they needed to do. I know the Minneapolis police pension was a challenging pension, and the state came in and dealt with some of the underfunding issues. And we also made some tough decisions in the 90s relative to retiree health insurance and the amount of money that the city was obligated to pay under that. They were very unpopular decisions, but it really helped us stabilize the resources. I think the challenge, when you're sitting in front of the credit rating agencies and they're looking at your overall picture, part of it is, do you have the political will to make the changes that you need to make to address these long-term challenges? And sometimes you have to say, look at, let me kind of get into a specific issue. We had with our sewer rating, we have a AAA rated sewer fund, which is really unusual. But one of the things they wanted to do, they look at cash on hand and debt service ratios, and they kind of upped the requirements that they were looking for, and we are risking a downgrade because we're not adjusting it immediately, but we have a long-term plan, a 3 to 4 year plan to get out of, to get to those levels that they want us to be at. So sometimes you kind of have to take a little bit of a risk as a city leader that you might get downgraded from AAA to a AA plus or whatever it might be. But if you're doing it, I think with a long-term strategic plan in place, that seems to me more prudent than just trying to adjust with a large swing in your revenues or your expenditures.
Okay. And just to follow a little bit on Wilshire Consulting had a report earlier this year, or actually about a month back, saying nationally pension funds are about 64% invested in equities, and I believe that includes real estate and private equity on it. Given that markets are the most volatile right now since about 2008, do you think that's too high, Suzanne?
It really depends. If you're CalPERS or you're a big state plan and you have a sophisticated management team that understands the risks. I mean, these are long-term assets, and some of these investments have more short-term volatility than really long-term volatility. But I think that requires a pretty sophisticated manager, and so while that might be perfectly acceptable for a large state plan, it might not be such a good idea for a locally managed plan that doesn't have that kind of investment sophistication.
What do you think on it, Natalie?
Yeah, I would definitely agree with that. I think that, the state plans have teams of people and consultants that are working with them. The smaller plans, and there are many of them around the country, really do need to be as conservative as possible. But, even a CalPERS is looking at de-risking their portfolio to sort of smooth out some of the gains and losses from one year to the next.
And just one more follow-up on the pensions here. Pension fund bonds, are they still a good idea given the volatility we're seeing right now in the markets?
The favorite question. I don't favor pension bonds in the sense that many times they're used to fund a distressed situation, and a slice of those assets are put into making this year's payment. And so if that's the reason for the borrowing, you no longer have those assets to earn on, so you've depleted some of those assets in order to create a window. That in itself may not be the worst thing in the world if you really have to create that kind of window, but it's oftentimes a sign of difficulty. And also, you are taking a bet on the performance of the market being better than what you have to pay out on the bonds.
Okay,
I
and
think,
good.
I think some, there's been some discussion about whether that takes sort of a hypothetical liability and converts it into a hard liability in today's, budget. The one thing it does do is convert it into something that you can't avoid in your budget process. And so now you're not saying, am I going to make a deposit to the pension plan versus pay salaries? Now the decision is, am I going to pay salaries or not pay debt service? And that may give local officials more cover, if you will, in the budget process because it's really a required payment. It's not discretionary anymore.
Okay, and just one final question that actually was raised earlier. Borrowing right now. I believe issuance right now in the municipal markets on or close to a record pace again this year. Majority of it, or at least the biggest portion of it, is refundings on it. Are cities being too cautious when it comes to borrowing, given how low rates are and the Federal Reserve basically looking for any opportunity to raise rates? What do you think?
I think that, yes, I mean, it's clear that new money borrowing for infrastructure is down. You can see it in the numbers since 2010 at the end of the Build America bond program. And interest rates are down, so everybody's asking, why isn't there more infrastructure spending taking place? I think maybe to the positive, there's a lot of noise this year because of the pre-presidential election. There have been a lot of elected officials that have taken the no tax hike pledge in the state legislatures as well as at the governor's level. I don't know the figures at the local level, but I think once the dust clears a little bit around the election, we may see some more new money borrowing and a little bit more hunkering down and getting down to business.
As a borrower, what's your perspective?
Well, we have restructured a lot of debt in the low interest environment and tried to refuel that into infrastructure. So last year we put together a plan of $40 million, just a pothole repair in the city of St. Paul, because we were able to refinance some debt on some of our public facilities, and that was really, really significant. So we were able to become more efficient. We were really trying to get rid of some of this old higher interest debt. But I think unless the federal government and the state government start kind of using this low interest rate environment to start investing in infrastructure and participating in some of these programs, the cities don't have the capacity to even touch, some of that. We have one bridge alone that needs to be replaced at the tune of $64 million. Well, in a city where your general fund budget is $250 million, you can't take that on by yourself. If we could do it in partnership, and we're working with the Department of Transportation, we've been working with the Tiger Grant program, we've been working with the state trying to get some resources for that. This is the time to do that. I mean, if you ask me what was the biggest concern that I have from a city perspective, it is this infrastructure issue, and it's never going to get cheaper to address it than it is right now, and it needs to be done.
Okay, great, thank you. Did you want to open the floor up for questions? Any questions for the panelists here?
It's your last chance.
I guess we got it.
There you go.
Do you think the new pension accounting rules are going to cause some budgetary concerns for the cities in terms of trying to cope with them?
I'll defer to the
No.
city. I think that, I guess once we have the widespread numbers of financial statements coming out with the new accounting, the pension accounting methodology changes, that's what you're talking about, David? I think it's going to be very interesting. I think some of the numbers are going to be so big, I'm not sure that people are going to know how to react to them. And we'll see some negative net asset positions, and I think it's going to be hard initially to really evaluate that. One thing the new regulations are going to do is allow you to calculate the impact of like a 1% change in the assumptions. And so that actually will allow a better comparison across the board, I think, among different participants and plans. But I think it's kind of yet to be seen. We haven't had so many financial statements come out yet under the new guidelines, so.
Any more questions?
This is probably for the mayor. We're starting to see this year crime statistics going up in many cities, and public safety was one of the major items listed. Maybe you could just comment a bit in terms of what you think is behind that and what some of the solutions are.
Yeah, it's very interesting. We are not one of the cities where crime rates have gone up. We've actually been very happy kind of where we're at. There has been a little blip in certain categories, but overall crime rates, level 1 crimes have been down. It's really been interesting to watch, and I don't know if it's almost like an economic cycle, which is, crime rates go up and they go down. I don't think that there's a good answer as to why we're seeing this increase, particularly in violent crimes. Not to throw my neighbor to the west under the bus, but Minneapolis has seen a real uptick in shootings, and I don't know if there's just I think everybody's trying to understand the data. I've worked very closely with my police chief to understand, first of all, why it's happening in other parts of the country, why it's not happening in the city of St. Paul, and is it coming to the city of St. Paul? Is that just a natural conclusion? But I think that the cities that are being very aggressive in their community-based policing, but that's a really resource-intensive kind of approach. So you have to have a lot of officers on the street to do true community-based policing. But the ones that are doing that, that are starting to build the relationships, that are going back upstream, working with kids very early to get them involved in out-of-school time programs, et cetera, are having more success than some of the communities that haven't invested in those types of policies. So, but those are all resource choices, and I think, so it is possible that one of the things that you're seeing is that our officers are just kind of reacting to 911 calls, or going from call to call, because we haven't been able to invest in some of the things that we'd like to invest in. So the long-term relationship building is not happening in some communities the way it should be. So that's just a theory that I have, but I don't know that there's any data to support it. I think time will tell.
You mentioned the presidential elections and Washington, D.C. What do you think could be done at the federal level to boost infrastructure spendings at the local level? Is there something that they're not doing that like they should do that to help like having more spendings at the local level, big cities and so on? For instance, in New York, you have the tunnel between New Jersey and New York, and then they're discussing about like financing, getting some help from the federal government to build a tunnel or this kind of thing. So do you see this as like a national issue also?
Well, the first thing the federal government could do is get their heads straightened out on the highway bill, and that would help a lot. They had continual short-term passage and continuity of that bill. You can't, it's very hard to plan long-term, long-lived infrastructure when you don't have a steady, regular financing source. And this piecemeal approach that unfortunately has been happening in Washington is very hard for the cities and states to deal with. So I don't think the federal government is jumping up and down right now, at least, to help solve those problems, unfortunately.
And the people said amen. So for one, one of the things I think, first of all, disaggregating the data that we have from the report is really trying to understand. So the cities that are in better fiscal shape versus the ones that are struggling, what are the reasons for that? I would posit that one of the reasons why some cities are doing well is because they have invested in infrastructure programs. I can directly tie the vitality in the city of St. Paul to the light rail line that was constructed between the two downtowns of Minneapolis and St. Paul. And you are seeing growth coming into downtown St. Paul that hasn't happened in 40 years. Is that a common thread? And if that's a common thread, and if you do believe that the cities are the backbone of the economies of the states, then the states are the economy, backbones of the economy of the nation, then to be talking about not investing in highway rebuilding or New Start programs for federal transportation systems, or you name it. The Build America bonds was a tool that many cities, including the city of St. Paul, used that was very successful in getting some things going during the course of the recession that wouldn't have happened. And if we had not been able to make those kinds of investments through the recession, the vitality and the resiliency of our community would not be where it is at today. So this disconnect between federal government, state government, and what's happening on the local level has got to stop, because people, it is absolutely critical to get some of these projects going in our communities if they're going to be strong.
Okay, one last question, anybody? All right, I'd like to thank everybody for participating in the panel today and for your time today.
Thank you.
Thank you.
They're getting their shot. Just want to say thank you all so much for coming to join us today at the 30th Annual City Fiscal Conditions Release event. Thank you. Have a great day.